Welcome, and thank you for joining us. Today, we'll explore how to do alpha research with MesoSim. Alpha is a signal that can predict future returns in a given trading strategy. In this case, we use MesoSim's analytics tool to test whether certain entry variables can reliably predict final P&L. The process begins by selecting variables at trade entry, then analyzing data using charts and statistics to identify patterns. If a variable consistently links to profitability, we refine our strategy by adding filters or conditions. Before we get started, we need a strategy to demonstrate how the process works. We'll use the built-in 0DTE Iron Condor template. To do this, open the Job Editor, and on the right-hand side, select 0DTE Iron Condor from the Template dropdown. It's important to note that the amount of data matters, so running a backtest over a longer period can provide more accurate results. Set the start period to 2020. Adjust cash to $50,000. Additionally, it's crucial to save data in variables at entry, as we're looking for values with predictive significance. If we only examine variables at exit, we're analyzing results rather than identifying potential predictors. For example, while positions delta continuously updates throughout the trade, the value stored at the exit position event reflects the position's delta exposure at the end. However, to determine if position delta at entry influences final P&L, we need to capture it at the moment the trade is placed. To achieve this, in the entry section, we define a variable that saves the initial value we want to track. Without this step, we would only see values after the trade has already played out, which doesn't help us identify leading indicators of performance. When defining a variable, always start by specifying its name and then assign a value. The choice of which variables to save is up to you. You can view the full list of built-in variables on the right side of the Job Editor to see which you can use as building blocks to define your own variables. For demonstration purposes, we'll save post delta as initial delta vega ratio, which is pos delta divided by pos vega, and initial vega gamma margin ratio, which is pos vega divided by pos gamma times pos margin. The initial vega gamma margin ratio evaluates how volatility risk vega compares to price movement risk gamma and margin. In Reg T margin, position margin is calculated as the maximum spread width, 25 points, minus the premium received, meaning it varies with the credit collected. Gamma can be crucial in 0DTE trades because it causes positions to react quickly to price changes. 0DTE options have high gamma sensitivity, leading to rapid price fluctuations. While Vega's impact is typically minimal due to the short time frame, this ratio helps determine if volatility risk holds predictive value. To include pos margin, ensure that the sim settings margin field is included. Now, proceed with running the backtest. Once complete, you can access the analytics by selecting the Analytics tab at the top. A key feature of this tab is that it utilizes data from the events. This means all variables available in the Events tab can be used for analysis here. The tool categorizes variables into three types: quantitative, categorical, and temporal. Let's quickly review the interface. The data panel contains the data fields, variables from events, and wildcard fields. Next to it is the encoding field, which contains shelves for mapping data to visual elements. X and Y are the key input fields for visualizations, drag and drop variables here to define the axes. Other shelves allow you to control size, color, shape, detail, text, and facets, which can be used to create trellis plots. A wildcard shelf lets you add fields without picking a specific variable. The filter panel lets you apply filters for each variable. The specified view displays the current specified chart that you made with the variables. In the related views, the system automatically generates charts. The variables can be highly useful for identifying relationships between them and P&L. The primary way to analyze these connections is through a scatter plot, where the x-axis represents position P&L and the y-axis represents one of the variables defined in the entry section. Now, let's test the variables we defined. First, we need to filter for the event type exit position, because only after the trade closes do we know the final P&L of the position. Once filtered, we can explore the variables to identify one that correlates with terminal P&L. To start, let's create a scatter plot. Simply drag the initial delta on the x-axis and the terminal P&L represented by position P&L on y-axis. As shown in the chart, the relationship between these variables does not display a strong or clear pattern. The same observation applies when using initial delta-vega ratio. However, when we look at the initial vega-gamma margin ratio, there seems to be a noisy but more discernible linear relationship. While it's not perfect, it shows potential predictive value, so we'll continue exploring this variable. Additionally, the chart's appearance is customizable. You can adjust it to use a bar, line, or other visual styles using the drop-down menu. Quantitative fields have a function pop-up for specifying various aggregations and bin. When we set pos P&L to mean an initial vega-gamma margin ratio to bin, the chart becomes much clearer. This is because these adjustments summarize and organize the data in a way that highlights trends. But what do these terms mean? Bin. This groups the ratio values into intervals or bins. Instead of plotting every single data point, the values are aggregated into these defined ranges. Mean. This calculates the average value of pos P&L for each bin of ratio. Rather than showing every individual pos P&L value, we display a single average for all the data points in a bin. We can further enhance our chart by using the count variable as a color. This helps visualize the density of data points within each bin. The chart reveals that the average position P&L is positive when the initial vega-gamma margin ratio exceeds 0.01. This suggests that trades meeting this condition tend to be profitable on average. With this insight, we can clone our backtest and apply an entry filter using entry abort condition. Pos vega divided by pos gamma times pos margin less than 0.01 to filter out unwanted entries. After running the updated backtest, we can compare the results. The compound annual growth rate improves from 3.08% to 4.41%. Max drawdown decreases from negative 8.4% to negative 4.2%, and the Sharpe ratio rises from 0.71 to 1.13. These improvements indicate a more favorable in-sample backtest performance. Finally, it's important to consider alpha decay, the rate at which a predictive signal loses its effectiveness over time. As strategies become more widely used, their edge often reduces. If the initial vega-gamma margin ratio loses its predictive power over time, this could be an indication of alpha decay. Regularly testing the robustness of an alpha factor across different time periods, performing out-of-sample testing, and validating it under different market conditions helps ensure its continued validity. And that's how you can analyze your trades using the Analytics tab. For further details, please check out our blog post. Thank you for watching.